What is up, everybody? Logan here again with another video coming right at you guys. And we have had a very interesting last couple of days. The price action has gone absolutely bonkers as of lately. And I think one of the things to be mindful of in this bear market, but still this little bull push, and we're awaiting CPI on Thursday, right? One thing that for us today, we actually had to take one of our rolls off. So in this video, I do want to go over my mindset with managing and rolling a little bit more than just showing the trade, showing why I took it, because this was a multi-day roll. This was a position we took on Friday, as you guys can see up here on the 6th. We took a call credit spread at 38.90. We ended up rolling that before it got in the money, kept the strikes the same, but then we did have to pull the strikes up because what happened on Monday was we actually continued this move up. So we wouldn't have been able to get out on Friday, even if we had held the whole day. And then we did get that push Monday. So we were sitting down here when the market was up here. And then I ended up taking this roll. I posted why I took the roll, which is basically on these shorter term time frames, we're pushing away from the mean, right? This is the last 20 days. This is the last 15 days. And if you're going to take a trade, you have to understand when it comes to the management part, especially if you're rolling and not just stopping out, because that's one thing about this trade in general is we actually got to keep overall about 40 credit on this trade. Where on Friday, anybody in a CCS got stopped out if you weren't able to roll, or if you panicked, closed the position. Some people did that, of course, anybody who was maybe rolled for their first time. If you were watching my videos and like wanted to follow along with the rolling. But I continue to stay with what I know, and that's when if price gets too far away from just a mean over time and you have multiple time frames that confirm that and you can get the timing well, you can actually do really well with rolling. So I did want to show that here, but I did wait to roll this position until we pushed out of 2.5 times the standard deviation from the mean to the upside, right? And if you're in call credits, you're going to be under some pressure. So what I did from there was we moved that position to the 39.30, 39.40 today, as you guys can see down here. I put that roll in yesterday. Before it to expire today. And of course, today we were able to take that trade off in the afternoon. We go to SPX stock, we would have had that expire worthless for us overall. Like there's something about risk, right? And holding into the afternoon, especially into power hour, I try to get us out by 3 o'clock, because getting us out by 3 o'clock, when the market closes at 4 Eastern time is really beneficial. Because the last hour is really hectic, and we've seen a lot of power hour pushes where you'll see a trade that you've had be almost worthless, and you could see a 20 to 30 point pump at the end of the day, and that would be enough to either stop your trade out, force you to roll. You're going to have a bunch of regret on why you didn't do anything prior. So that's what I want to show a little bit more in this video. And if we go over the checklist, right, we were using that expected move math on Friday. We had a little bit bigger of an expected move and the market was pumping all day. So we overall just took a trade based on that 2.1% up, right, is where I tried to place us. It's good like 91.5% of the time. Well, that did get broken, and that's what made us roll the trade, right, is when I saw that was continuing to steam up and steam up and steam up even further, and it just continued to go up. One thing to be mindful of is the time of the day that we rolled that trade. And I try to wait until the afternoon, especially when you have that good of probability. And you guys can see here, rolled that at 213. And then it was just a slightly higher debit if you didn't get that in within the hour. But that's something as a day trader is you need to be ready to make these moves. If you're someone who wants to do 0 DTE trades, it's very hard to do this if you have a very busy schedule. Generally, you can get away with it, but sometimes it will run away from you. And then I even waited till about that 1 p.m. mark, which was when the market, it did go up. We got that clear rejection at 39.50, which was a massive price target for a lot of people and even the short-term bulls, where we would see some cooling off after that. So if we're to lose 38.80, we would then push back down to probably this 38.50 zone. But if we can hold this up here, we might get that push to 4,000. I'm not someone to predict price. My plan is just to react to it and use the best rational measurement I can. And as long as you size properly, you should have a lot of leeway to work your way in and out of these positions and not just be constantly stopping out and constantly chasing losses and getting greedy when you have good profits just to give it all away because you don't have a steady and solid plan or a steady and solid sizing plan. So that's one thing about these trades specifically is I was just using these two charts for my timing on this and saying we are overall in a short-term bullish trend, but if we can get this roll at the right time, it'll take pressure off our strikes, and then we could possibly get out of this for a very small amount of a loss, but we still actually won on the trade, which this was sitting at a max loss going into Monday. But with widening the strikes, taking on more risk, we're able to position ourselves better for a little bit of a pullback when you're in that call credit spread. And that's my mindset when it comes to these, right? Is how can we look at mitigating our actual position risk, right? When you're down at 38.90 and the market's at 39.30, you want to do something to get your strikes in a better spot. Now, granted, rolling put credit spreads are a little bit touchier because the market really does like to elevator down and staircase up. So I find that rolling put credit spreads can be a little bit more difficult. But I think overall with this specific trade and how extended we were, that's one thing you have to just have great market situational awareness. And if you're properly sized, you should be able just to look at the market and not feel emotions in a position and just do what you need to do to continue the upward trend. And you can set your goals and then also be strict on your rules and flexible on your expectations so that you can continue to build this port over time. Because all trading really is just setting goals, right? Setting strict rules, and the money will take care of itself if you have a really solid plan. A lot of people don't have a plan, and that's where they get caught up in trading, is if you don't have a plan, right? And this can be common with any sort of risk taking, real estate, whatever it is. If you don't have a plan, it's very hard to want to look at the long term because you can get caught in short term like step backs, any sort of pullback, pull down on what you want to do over the long term. So that's one thing that I wanted to touch on a little bit in this video. So overall, trade went well. I just wanted to walk you guys through my mindset, but I think that's one of the cool things too about the Discord sitting in this trade was they also really weren't too worried because a lot of them are properly sized. And they were able to see how the price action can work for you. And when the market internal started to tip after we get that clear 39.50 rejection, it's a lot easier to make a better decision when you are hitting those levels that you set and whatever your thesis is for being in the trade and sticking to that. So overall, really solid trades. I'm looking forward to trading through the rest of the week. We have Wednesday, really nothing too crazy, but Thursday is CPI data. So that's something that I'm going to steer clear of. I doubt I'll trade Thursday. I would need an absolute perfect setup. And then Friday, we'll see if there actually is some follow through on the move or if, it's a complete fake out because the market makers have been loving faking people out where maybe there is a big 5% move up and the next day moves down 2%, or maybe it's a 3% move up and the next day is down 4%. So they like to just play ping pong with this market as of recent. And today was perfect because we gapped down in the morning. If we go back to the checklist, you guys can see here, and it immediately filled like upon open after the Powell speech came out. And I think that's one really interesting thing. There was really no new news that we got out of that. But overall, the VIX stays around 21 as of lately, just basing. So, the market's a little bit more interesting, but the moves are smaller. So if you're able to roll on big days and then wait for the next day of consolidation, if you're out of the money, you're in a good spot, right? Overall, we didn't exceed the expected move on Monday, but the one thing that was really interesting was we were exceeding it in almost 2x the EM for quite some time up to the upside. And then by the end of the day, it'd fall back within, which really helped our position out, right? Because we were able to get that roll right around the EM high of the day. Position sizing, like I said, most of my trades are 5 to 6% of my port when I take one. And that's just so I can maneuver out of anything. And plus, like, you're working with leverage. And I'm not saying you have to use the rest of your port all the time. But I'm also, we're in a really crazy time. These markets are just up, down, sideways, up, down, 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 right? A lot of fake outs, a lot of breakouts. And I think that's one thing that comes with a bear market is just reducing risk. And it really sets you back and like makes you think, like, do I really have to be utilizing all of my capital all the time? And if you don't, then really what's the point, right? Like, why risk a bunch of money when you can risk a little amount and have a really solid set of rules? Because once we get out of this market, you can go back to doing what you were doing in all of the bull markets over time, right? Selling put credit spreads at an 85% chance out of the money and just collecting over time. But we have to be more creative in a market like this where the moves are a little bit more hectic, the expected moves are getting destroyed. So you just have to be more on your toes. And when it came for me choosing these strikes, that's probably my biggest question when it comes to rolling, is like, how'd you choose these strikes? And it was basically, we have that 39.50 rejection when I pulled this up. And the first roll was just because we could get a small credit. And anytime you have a short-term like crazy move, that's one thing you have to be like really patient with is, okay, let's just roll these strikes into the next expiration day because we already seen a really crazy move. The chances this follows through are low, right? Because you're already far away from the mean and price will eventually revert back to the mean. So you can roll it into the next day without widening. And then let's say the price action continues to be crazy, like we did see back here. You wait till you get a clear rejection and you can come back to these moving averages. And then you can really, really set yourself up and look at, okay, what did we do the last time we got this really far extended? Well, we came back to the averages on this channel of the 20-day, 30-minute. So if we're still having a gap from those, right, that we have to head down towards and hit those moving averages, not like an open gap, and you look back at your 15-day, 10-minute chart and you go, man, these are really short-term like extensions, right? Like these are so short-term, like we're extended. You can really set yourself up well and then get a little bit of relief to where even though the market had a green day, right, with rolling your call credits, if you roll them up here like we did, then you had that selling. And then the next day, even though it was a green day, you had all this time to get that decay, right? And what I mean by decay is overnight, you get the decay and the price action dropped by the time we opened. And I think it was trading for probably 80 cents to $1 upon open. And then as the day goes on, the expected move is going to shrink, right? And you're going to get that volatility decay. And that's what sets your trade up really well to take off, right? And the market's all about reducing risk to where a lot of people have gotten eaten up in call credits on this side of the trade. And you have to be very mindful of just the situational market awareness. But that's going to be everything for me in this video. I hope to help you guys out greatly in this one. I appreciate all the support as always, the likes, the comments, the subscriptions. I hope you guys enjoyed this. And I hope you guys come back for another one because it's super fun. I love making videos and I've gotten a lot of questions about rolling and my mindset with it and when to choose the strikes. So that's going to be everything for me. If you guys would like to come and join the Discord, the link is below in the description. That'll be everything for me and I'll see you guys in the next video.